Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Tiffany Ng, Portfolio Manager at Renaissance Capital, which is a global IPO investment advisory firm. So we're talking about the IPO market today, which we haven't done in a while since there wasn't much to talk about. And now it seems that the IPO market is waking up from a long slumber. And after a disastrous performance last year, the Renaissance IPO ETF is up more than 44% year to date. And some of the recent IPOs, including Mediterranean food chain Kava and online beauty products retailer Oddity, they have had quite successful public debuts. So I wanted to start with this fear of missing out for IPOs with you, Tiffany. Welcome and thanks for joining us today.
Hi, Nina. Thank you for having me.
So I read in a recent journal article that IPO investors have moved from a fear of losing money to a fear of missing out. So tell us about your thoughts. Do you think investors are experiencing that FOMO for IPOs again?
Yeah, I saw that article, but I wouldn't necessarily say that investors are experiencing IPO FOMO right now. I'm thinking back to 2020 and 2021 when investors really needed a reason not to buy an IPO. So I think that was FOMO. But there is definitely renewed interest in IPOs, which we're seeing by way of increased trading volume and strong inflows into our IPO ETF. You mentioned it's gained over 40% this year. But there is still, I think, discernment in the new issuance market. So I'd say that investors are definitely interested in looking at IPOs now, but are also happy to pass on them if they feel the business isn't compelling or if the valuation isn't attractive enough. So they're okay missing out on the Kavas or the oddities if they're not convinced.
So that's a healthy trend. So let's talk about the volumes that you have seen this year. Tell us how many companies have gone public so far this year and about the funds that have been raised. And could you also tell us how that compares with the numbers from the previous year?
Sure, yeah. The IPO market really is starting to wake up this year. So far this year, 58 companies have gone public, raising a total of $9.8 billion, which is already more than the $7.7 billion raised for all of 2022. Now, that does include Kenvue, which is the Johnson & Johnson consumer unit. So that's the Tylenol and Band-Aid business. So Kenvue raised $3.8 billion in May. But even excluding that outlier blockbuster IPO where it's $6 billion in year-to-date proceeds, and that's compared to just $4.4 billion at the same time last year. And IPO activity is definitely still below historical averages at this point, but we're definitely seeing momentum building and there's a sense of optimism in the markets. And that's because we're starting to see the finish line in terms of Fed rate hikes. The recession that everyone's been waiting for hasn't happened yet. The sky hasn't fallen. So the economy seems to be holding up. Consumer sentiment seems to be holding up. So IPO activity has been able to build on the back of that. And I would just add that we have seen a number of quite successful consumer IPOs in recent months. But beyond that, we've also seen IPOs from a number of biotechs as well as from more defensive sectors like energy, industrials, and financials. So we've had really healthy cross-sector issuance coming to market this year, which is really great to see.
Okay, very interesting trends for sure. So if I remember correctly, 2021 was a record year for IPOs and money raised by US IPOs, including SPACs, was the highest on record for any full year. And one trend that we saw in 2020 as well as in 2021, that investors had a lot of appetite for loss-making companies, the companies that were still losing money but growing rapidly. They were among the most popular IPOs in 2020 and 2021. And one of the main reasons was that interest rates were close to zero at that point of time. And so investors were willing to pay that kind of big premium for potential big returns in the future. Now, some of these companies have struggled lately. They have faced cash crunch also, and many of these stocks have tumbled. So, what about investors' appetite for unprofitable companies now? Has that changed?
Yeah, like you said, the era of free money is over now. So I think that appetite for the growth at all costs type of company is not there anymore. But I think that companies that can show a near-term inflection point for profitability can still be well received, even if they're showing losses now. So there haven't really been many unprofitable companies come to market recently outside of biotechs, but maybe Kava is an example of this actually. Kava's had negative free cash flow for a few years and will continue to invest in its growth in the near future, but it's demonstrating a path to profitability in the next couple of years, and it's been rewarded for that in the public markets.
And what is your outlook for the rest of this year? How many companies do you expect to go public, and how much money is expected to be raised?
Sure. So, yeah, success breeds success, right? So, we've had a number of larger IPOs in recent months that have been well received. And we mentioned the IPO ETF is up over 40% this year, which is more than double the S&P return. And just looking at past cycles, the performance of the IPO index has really been a leading indicator for IPO issuance activity. So, this bodes well for the IPO market going into the fall. All signs are pointing to a pickup in IPOs in the back half of this year. We're expecting the IPO market will continue to gain momentum and get back into the full swing of things in 2024. In terms of numbers, we're estimating we'll finish with about 100 IPOs raising about $30 billion, which would still be a relatively slow year historically, but is a significant step up from 2022. So we're not out of the woods yet. Inflation's still high. The recession risk is still there, but there are definitely green shoots in the IPO market, and we're cautiously optimistic.
Right. And one of the most anticipated IPO of this year could be the public debut of ARM, British chip designer company. And I read that NVIDIA is expected to be an anchor investor in this IPO. And NVIDIA was actually interested in acquiring this company, but last year their planned $66 billion acquisition was blocked by the regulators, so they had to abandon that deal. Now, this is a very important company. According to FT, 95% of premium smartphones use ARM's technology, and its chips are used in PCs, other AI applications and servers as well. And their clients include Apple and, of course, NVIDIA, Samsung, and Qualcomm. So I don't think I understand the role of an anchor investor properly. And I also read that Kava and Oddity's IPOs benefited from support by their anchor investors. So could you talk a little bit about ARM's proposed IPO and also the role of an anchor investor?
So I think in general, anchor investors can help reassure other investors, especially in more difficult market environments. So it's a sign of support and confidence in the deal. And you mentioned a number of recent IPOs, including Kava, Oddity Tech, Savers Value Village, these companies that were kind of brave enough to test the IPO window before it was fully open. They each brought on cornerstone investors or anchor investors for a chunk of the deal. And I think that those were helpful signs of support for the deals in a really uncertain market. For ARM, though, yeah, I think the anchor investment from NVIDIA could be a boost of confidence for the deal, but I also think it's maybe less important for ARM since it has been a public company in the past, so it's a known quantity. And I'm thinking maybe the NVIDIA investment serves more to shore up ARM's pitch that it's an AI play, which I'm sure will be a major part of the story given all the hype around artificial intelligence these days.
Right. So let's talk about some other prominent unicorns that could make their public debut in this year in 2023. I read that some of other prominent startups like Stripe and Reddit have postponed their plans to go IPO this year. But there are some other companies, some very interesting companies that could make their public debut this year. Could you talk about them?
Yeah, absolutely. We are tracking a pretty robust pipeline of potential IPOs, and we're expecting some well-known names to move forward in the near future. So we've had a number of successful consumer IPOs this year, so we're expecting other consumer IPOs in the fall. We could see other restaurant IPOs like Panera, Inspire Brands, which owns Dunkin', Buffalo Wild Wings, and others. We could see Fogo, the Brazilian steakhouse chain, which has been on file and has really shown sustained profitable growth in the post-pandemic era. We're also tracking some other consumer names that could go public this fall, like Turo, the car-sharing platform, and Birkenstock, the footwear brand, has been in the news. There's also maybe more techie names like SeatGeek, an event ticketing platform that pulled out of a SPAC merger, could go public the regular way. And Klaviyo, which is an email marketing platform that filed confidentially a couple months ago.
Very interesting. So another trend that we have seen this year is that many newly public companies are being taken private. And in fact, Bloomberg reported last month that there have been 47 proposed or completed deals to take a public company private. And that is lower than the number of IPOs, at least till last month. So tell us what is happening. Why are so many newly public companies being taken private?
Yeah, I think that's probably a function of the performance slump in the past year or two, right? So that's taken a lot of quality companies down to quite reasonable valuations, which make them attractive targets for private equity firms. And then on the other side of things, public investors are hyper-focused on short-term results, and so it's probably not the most forgiving place to be a public company in a down market.
So let's talk about your index, the IPO index, and your ETF. Tell us a little bit about the methodology. And when I'm looking at the holdings, I see companies like Airbnb, Snowflake, Palantir Technology, and DoorDash among the top holdings. So these also talk to us about some of the best performers and worst performers in the index.
Yeah, so we operate the Renaissance IPO Index, which holds US listed IPOs, and the Renaissance International IPO Index, which holds non-US listed IPOs. And we're holding a rolling 3-year population of the largest, most liquid IPOs, which are most likely to succeed. The US index, which is tracked by the Renaissance IPO ETF, ticker IPO, has done quite well this year and is really the best benchmark for the performance of the US IPO market. You mentioned some of our largest holdings. They've done quite well this year, including Snowflake and Palantir, which are both tech names that have benefited from the hype around artificial intelligence, which has really driven the tech rally recently. And I also highlight Airbnb, the largest holding in the IPO index and IPO ETF, which has been doing quite well both since its IPO and in recent months. I think as a reflection of consumers wanting to go out and have experiences post-pandemic. So that's another success in the consumer space. And then on the other end of things, I maybe mentioned Rivian, the electric SUV and truck company startup that's really struggled since its IPO and has been a drag on index and ETF performance, although it's fared a bit better in recent months. And I think that's not terribly surprising if you just look at the profile of the company. It's burning a ton of cash with profitability nowhere in sight, which is a concern for investors in this market environment where money is no longer free, as we talked about. But Rivian stock has been trending up recently, along with other EV, electrical vehicle stocks, which is a sign that investor appetite for risk is returning. So I mentioned that our index and ETF holds IPOs on a rolling 3-year basis. So right now, the majority of our constituents are from the 2020 and 2021 classes of IPOs, just given the lack of deal flow recently. So many of those that achieved very high valuations at IPO were crushed when multiples contracted in 2022. And over half of our constituents are still trading below their IPO prices. But a lot of those valuations are looking more attractive now, and we're starting to see a lot of those bouncing back as the risk appetite returns, which is to say there's still plenty of runway for the recovery that has just started.
So you mentioned that most of the constituents currently are from the class of 2021 and 2022 IPOs. So what about the companies that went public this year, including like the ones we briefly discussed, Kava and Oddity? When do you expect them to be included in the index and the ETF?
The index and the ETF are rebalanced quarterly, so we'll look at including those at the next rebalance. In our most recent rebalance, we did add the Johnson & Johnson carve-out that I mentioned, Kenvue, which IPO'd in May. So we added that in mid-June.
So switching gears a little bit, I wanted to talk about the investment case for IPOs. Tell us why IPOs should have a place in an investor's portfolio.
Sure. Well, so for one, IPOs are often bringing to market innovative technologies and products and disruptive business models that can drive sustained growth and differentiated returns. And then more generally, we believe that IPOs are an important part of a well-diversified portfolio, which many investors don't think about, that you'd want exposure to fresh new stocks alongside more seasoned equities. So we've constructed our IPO indices and our IPO ETFs to provide optimized exposure to the IPO class, if you will. So they're both, as I mentioned, designed to hold the largest, most liquid IPOs on a rolling 3-year basis, which historically are the most likely to succeed. So yes, we believe that IPOs are an important part of a well-diversified portfolio, and we think our IPO ETFs offer an easy way to access these fresh new stocks that may not be household names, that are not yet included in major indices, and they tend to be underowned.
Excellent stuff, Tiffany. Thank you so much for joining us today. Really enjoyed the conversation.
Thank you.
That was Tiffany Ng from Renaissance Capital. So investors should remember the risks associated with investing in newly public companies because there's very little public information available compared to established public companies that have been reporting quarterly results for many quarters and years. So investors have to make their decisions with more unknown variables. And some IPOs can be very successful. Some IPOs have been very successful and some fail miserably. So ETFs can provide a relatively safer way to get a diversified exposure to newly public companies because they invest in a basket of newly public companies, so which helps to reduce the risk of one of these IPOs underperforming, one or a few of these IPOs underperforming or failing. And IPO ETFs provide exposure to these newly public companies before they join other core US equity indexes. As Stephanie mentioned, most broad market indexes include newly public companies only after a seasoning period. That means after they have been trading for some time. For example, Google was included in the S&P 500 index about 2 years after its debut and after it had already surged a lot. The Renaissance IPO ETF, ticker symbol IPO, that we discussed today, holds the largest and most liquid newly listed US IPOs, and companies that have been public for 3 years are removed at the next quarterly review. This ETF, as we mentioned earlier, is about is up about 44% this year. It has 230 million in assets and then has an expense ratio of 60 basis points. The other IPO ETF is by First Trust. It is the First Trust US Equity Opportunities ETF. The ticker symbol is FPX. It holds the 100 largest and most liquid US IPOs, and these eligible companies are included after the 6th day of their trading, and they are held in the index and the ETF for about 4 years. This is a bigger product, has about 820 million in assets and has a similar expense ratio of 61 basis points. This is up about 18% this year. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe to our show so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.